Today, we're going to be looking at the trade desk. Okay, the stock has been absolutely destroyed. Okay, we're talking about roughly 90% down from the all-time highs. Okay, so this is not a normal correction. This is looking like roadkill. And what makes this interesting is that the trade desk used to be one of the hyped up stocks in the market. It had fast revenue growth, high margins, strong free cash flow, and a founder-led business. It had a huge position in digital advertising, and for years the market was just willing to pay an absurd valuation for this. Now the story has completely changed. Growth has slowed, execution has disappointed, competition is getting more aggressive, and the market has gone from pricing the trade desk like an unstoppable compounder to pricing it like something is not necessarily completely broken, but something like something that doesn't have growth anymore. And the market says that this is permanently impaired, that the business has been permanently impaired. And the multiple right now is like 14%. First, we're going to talk about the business, and then we're going to run the numbers, and you will see that there are a lot of red flags with this company. Okay, so the stock is down 90%, but does that mean that it is cheap? No, not at all. That's too easy. Just saying, oh, 90% down, 90% discount. No, that it doesn't work like that, because a stock can fall 90% and still be very expensive if two things happened. If the original valuation was extremely high and detached from reality, and it came down to like something that is normal, and also the business margins can deteriorate and earnings can go down, and so the valuation can still remain high even if the stock price went down 90%. So this is a good lesson to learn. You're gonna learn a lot of stuff in this video. How if you're here and you got burned by this stock, you're gonna learn not to buy when it's very high. Okay, we buy low here, unhyped, when everyone hates it, when nobody really likes it anymore, and then we sell when it's high. Okay, so we're gonna take a look at the trade desk. Is the business still strong? Is the moat still there? Did it even have a moat? Are the economics still good? Because if those things are true, then 90% collapse might become interesting. And I'm just gonna tell you right now, I do own a little bit of trade desk stock in my margin account. Very little, just as a nuclear option in case this can go berserk if revenue growth start accelerating again. So this is like a trade. This is not part of my investable universe. The business is just not strong enough. It doesn't have the moat, and you will see soon what the competition is for the stock. Okay, so what does the trade desk actually do? The simplest way to understand is basically this. The trade desk helps advertisers to buy digital advertising. Okay, that's the business. Let's say Nike or Coca-Cola or PepsiCo or Walmart wants to run a campaign. They want ads on websites. They want ads on streaming TV, mobile apps, podcasts, maybe digital billboards. So they could try to buy all that separately, or they could use the trade desk. Okay, the trade desk gives advertisers and agencies one platform where they can decide who should see the ad, where should it appear, how much should we bid, which inventory is worth buying. Okay, and then is the campaign actually producing a return? The trade desk is what's called a DSP, a demand side platform, meaning that it sits on the advertiser's side of the transaction. Advertisers bring the money, publishers and media companies bring the advertising inventory. Okay, the trade desk sits in the middle, and then it helps decide what inventory to buy, and it does this programmatically. So basically, software is making a huge number of bidding decisions in real time, and ad impressions. An ad impression becomes available. The trade desk then evaluates it. Who is viewing? What device are they using? What is the advertiser trying to achieve? What is that impression worth? And then the platform decides whether to bid. All of this obviously happens incredibly fast. And the trade desk gets paid as advertising spend flows spend flows through the platform. So that's why this business became so attractive. It doesn't need to own websites. It doesn't need to own streaming service. It doesn't need to create content. Doesn't need to have mobile games, games on mobile, on Android or iOS. It sits above that. Okay, it helps advertiser decide where to spend the money. So basically, the model is advertiser, the trade desk, the open internet, the audience. Okay, simple enough. So the interesting part is why the advertisers should choose the trade desk instead of Google, Amazon, Meta, or maybe other platform. This is where we are going to talk about the moat. So let's talk about the moat, because the trade desk definitely has one, but I would not put it in the same category even as something like Copart, which we talked about in the last video. So if the trade desk disappears tomorrow, advertising would not stop, okay? They have alternatives, and that matters. The strongest part of the moat is probably scale plus data. So the trade desk sits across hundreds of inventory sources and processes enormous amounts of advertising activity. Its platform is directly integrated with more than 430 exchanges, publishers, and supply-side platforms. That gives advertisers broad access to streaming TV, websites, mobile, audio, and other channels as well. And then there is workflow. Large agencies can build campaigns, reporting, first-party data integrations, and internal processes around the trade desk. So that creates friction, but that doesn't mean captivity. So the contract themselves do not lock clients in very hard as well. The trade desk they say customers generally can terminate with 60 days notice, and they are not obligated to spend through the platform. So the moat has to be earned continuously through performance. This is very important, because if another DSP produces better returns, advertisers can just move money. And the main competitors here are very serious. Okay, Google DV360, Amazon DSP, and then other smaller DSPs such as Yahoo. The trade desk itself says Google and Amazon are major competitors, and some of those companies have vastly more resources, of course. Talking about Amazon and Google here, and they have huge first-party data sets and direct access to inventory inside their own ecosystems. But here's where the trade desk has some kind of argument. Google and Amazon own media and advertising inventory. The trade desk does not. It's focused on the buy side. So its pitch basically is, I'm not trying to sell you my inventory, I'm trying to find you the best inventory. So when you go to advertise with Google, they already have the inventory. When you go to advertise with the trade desk, they can find you the best inventory that they can. So yes, these are in competition with each other, but not 100% overlap. So Amazon DSP and Google DSP would be a almost 100% overlap in the way they sell advertising. So there are products of trade desks that are trying to strengthen the ecosystem. OpenPath connects advertisers more directly with publishers. UID2 is an identity framework designed as an alternative to traditional third-party cookies. So, but I wouldn't treat any of those features individually as some kind of magical moat. The bigger moat is the entire system working together. So advertising relationships, agency workflows, data, inventory access, measurement, and enough scale to keep improving the platform. So the trade desk has a real moat, but it's a performance moat. Customers stay because the platform works, not because leaving would cause the company to stop functioning. Okay, Nike can just find somewhere else to advertise. So that means competition matters a lot more here than it does in the hardest businesses that I normally look for. Google has scale, Amazon has massive commerce data. They both own enormous ecosystems, of course, and the trade desk has independence and focus. This is basically the fight. But this is, again, it is a brutal fight for the trade desk, okay? But the key question is very simple here. Can the trade desk keep producing enough value for advertisers that they continue choosing the trade desk instead of others, instead of other powerful alternatives that are just sitting there waiting. So yeah, that's a question. I mean, nobody can really answer clearly. You have to think about it. You have to make predictions on your own. You have to make some logical arguments for yourself when investing. This is why investing is not very clear. So for me personally, the trade desk, because it has this very small performance mode, I mean, if they don't execute properly, if they fail in any significant way, margins can just collapse. And this 90% drop can soon become 95%, 97%. And from even this measly smaller $6 billion market cap, it can turn into 2 billion and then 1 billion. So you have to make predictions for yourself. Again, I don't have this in my investable universe. The moat is not strong enough. The neighborhood that it lives in is very rough. Okay, it lives with the big Google, the Amazon. You don't want, generally, when you invest in a business, you just don't want Amazon as your primary competitor, okay, or Google or any of these guys. Microsoft is not is very relevant if you're a software company, but Amazon has failed brutally. They got very lucky with Sundar. But anyway, let's move on to stock analysis, and we're going to take a look at the numbers because they are not clean, okay? You can see that the business is not the strongest, and the future is not very predictable. So here we have the trade desk trading at 15 times 4P, which is non-GAAP. Let's just consider it 16 to 17P. But it's trading at $14. Used to be trading at 140. Ridiculous drop. It had a lot of air in its valuation. The business is growing, but when we take a more in-depth look at the numbers, you will see that it's slowing and slowing down considerably. Here's the income statement, 3 billion trailing 12 months. Last year they did 2.9 billion. Hopefully they can raise this to like 3.5 by the end of the year. But yeah, as you can see here, 25% top line revenue growth 2024, 18% 2025. Trailing 12 months, this is 11% only. Not, I mean, last quarter grew by 3%. Is this something having to do with cyclicality? I mean, it did go down before in growth and come back up again. Could be some weak spending from the advertiser side. But yeah, let's take a look at the shares outstanding. This is a company that is just gonna dilute you to death when the valuation is high, because they give out a lot of money in stock-based compensation. I'm gonna show you next. But the high of the total shares outstanding, 500 million, back 3 years ago, let's say 2 years ago, 2024. And then started to dip a bit because they said, yeah, we need to support the prices that are falling like a knife. And now we have 20 million less in the trailing 12 months. So they reduced 1.6%, and trailing 12 months, they reduced 4%, which is a good sign that they can do it. So yeah, free cash flow going up nicely and consistently. Hopefully this can continue. But yeah, the margins are not very consistent. Went down to about 7% to 2022, went back up again. Hopefully they will maintain a higher level. Also, the gross margin fluctuates. A little bit of cyclicality, I guess, with the advertisers, but yeah, at least they're quite consistent in the free cash flow since like 5 or 6 years ago, which is nice. Let's take a look at the balance sheet. They have around 1.1 billion in cash and cash equivalents right now. They had 1.3 in 2024. For a market cap of 6 to 7 billion, it's not bad. Let's take a look at the long-term debt. There is none. Total liabilities, $3 billion and dropping. Let's take a look here. So shareholders' equity, 2.5 billion. Net cash is 1 billion. So this is very good. They are net cash positive. And this is a good sign that because they can keep doing some more buybacks without going into debt. Total debt is 400 million, but it's nothing too crazy it's not much more than they had in 2024, which is 300 million. They even had 300 million back in 2020, but the market cap was much, much higher back then. What I'm saying is that the business, which was much smaller, while the market cap was indeed higher back then. So 400 million is not really a problem, and I like to see that they have more than 1 billion in cash, in net cash. So let's take a look at the cash flows, because this is where the problems start. So the net income, obviously positive 400 million, stock-based compensation more than the net income. So you already see that if you ignore this number, this is what can happen to you. You get into a stock that can go down by 90%. This is one of the style of Cathy Wood investments. Very high growth, maybe unprofitable, but definitely extremely high stock-based compensation. And this is like a plague for the company. And that's why when the story stops being excellent, when the numbers stop being excellent, because it was valued so high and because it has so much stock-based comp, I mean, the stock price is just going to fall like a knife. It's going to drop 90%, which is brutal. Of course, you're losing 90% of your money on the, if you held from, you didn't even have to buy at the top. I mean, you just had the value amount at one point, and that value dropped by 90% since you do not want to have these swings. This is a massive, massive red flag. This is mostly tied up to the CEO getting paid. He received like 800 million or something close to $1 billion in some kind of performance tied to the company type of award. But this company also produced a lot of millionaires, millionaire employees. So that's a problem to you as a shareholder. Your value in money goes down a lot by being invested with this company. This company is producing millionaires when it comes to the employees, and the CEO is obviously increasing his net worth. Your net worth is getting, it's plummeting. So this is very bad. I hate stock-based compensation. Do not ignore this, guys. This is very, very important. Whenever you see stock-based compensation, especially a level that is higher than the net income, I recommend that you stay away. So they could pay out very high stock-based comp for a while if the company has a very nice growth prospects to it, and it keeps on growing. But this, as you can see, the growth has slowed down a lot for this company. So the growth isn't there. So the net income trailing 12 months might be 500 million by the end of the year, and next year might be 550, and you're still going to be stuck with this massive stock-based compensation. I mean, this is not going to go easily because they already awarded. It's like a contract type. It's not so easy to just cut that. Once you gave out so many shares to your employees, and they keep diluting you to death because those employees just sell it off on the market, and it's a plague, guys. Try to stay away. Pick businesses. I mean, this business doesn't have such a strong moat. Okay, there are many businesses like this that you should just stay away from. CrowdStrike comes to mind. There is very hot right now, but could very well drop like a rock. Repurchases of common stock. Last year they did 1.5 billion. So this is a green flag. Good to see that they did 1.5 without going too much into debt. They used their cash reserves and their free cash flow to buy back stock, and they're still net cash positive for about 1 billion, while also they already did 1 billion in trailing 12 months in buybacks. Also, the CEO, he bought back a little bit of shares, like 100 million, 160, I think, or 150. I'm not sure. You need to check that. But yeah, the free cash flow goes up nicely. Hopefully this can continue. Like I said, I am invested with the company, but I hate it because the stock-based comp is just like a disease, like a cancer for the stock price and for the company as well. I mean, they're just handing out this money, and instead of reinvesting it into the business, I mean, 500 million every single year. They already paid out like billions, like 3 billions in stock-based comp, and the market cap right now is like 6 billion. So that's not something you can ignore. Look at this market cap, 6.6 billion, used to be more than 60. P ratio, let's look at the valuation. It used to be trading at 400 P. This is very bad, of course. But let's just say this was a fluke because the operating margins also collapsed in 2022. So let's take a look at 2024, okay? 150. This should have never been trading at that level because this doesn't have a very solid moat. Even 2 years ago, we knew that it was in competition with Google and Amazon. It wasn't like it was a surprise. So the market, there is a lot of stupidity in the market. Whenever they see some type of high growth number, there is also a lot of manipulation. They try to hype up the name so that the smart money can get out at a very high price. And then you get burned by buying into these companies. You get hyped up as well, emotional. You get emotional, like we talked in previous videos. You get stupid when you're emotional, like just like Bill Ackman is stupid when he gets emotional. And then you buy into something like 150p, and then it drops massively. And now the valuation is in the toilet, but compared to its history, 16p is not that low. Okay. I'm not getting excited looking at the PE of 16 right now for trade desk because this growth and the future growth prospects, considering the competition it has and the performance mode that it constantly has to execute perfectly, I just don't think this is a low enough multiple to just invest for the long term. I only put some capital into it as a nuclear option. If this changes around in growth, if growth accelerates, this can pop like quickly, like 80%, 100% from where it's at right now. So I would be selling it immediately. So I bought in at like 14. If this goes up near 30, I'm immediately getting out. This is not a long-term investment. This is just not strong enough of a company for me personally. So ROIC, return on invested capital, very nice, very high number, very good, obviously not consistent. That's why you cannot make very good predictions. FCF yield also very high, 13% is good. So you have quite a few safety nets with this company, and